Hey everyone, welcome back to the channel where I break down complex financial concepts into easy-to-understand bites. Today, we're diving into the core satellite portfolio strategy, a powerful approach to building a diversified and dynamic investment portfolio. Let's get started. So what exactly is a core satellite portfolio? Think of it as a two-part strategy. The core is your sun. It's the stable part where you invest 70 to 80% of your total investments and provides consistent returns. These are low-cost, diversified investments like index funds, ETF that track major indices like the S&P 500 or the MSCI World. The satellite are your planets that revolves around the sun. It is the more flexible, tactical part where you invest 20 to 30% of your total investments. These are smaller, more adventurous investments like active funds, individual stocks that allows you to take advantage of market opportunities and trends. Whether you're a seasoned investor or just starting out, this core satellite portfolio strategy can help you balance stability with growth. Together, they create a balanced and adaptable investment approach, combining best of both worlds. Let's break it down further with an illustration. Suppose if you like to build a house. The core is like a foundation of your house. The goal here is to capture the overall market's performance over time. As you don't change your foundation often, similarly, funds invested in core should be invested with long-term horizon. It's your set-it-and-forget-it component, providing steady, reliable returns with lower cost and lesser risk. The satellite is your roof of the house where things get interesting. This part of your portfolio is more active and strategic. It may have higher cost and higher reward as well. Investments here may have shorter time horizon. In addition to the roof, you may have a garden, driveway, garage, and a car. Similarly, as part of the satellite portfolio, you can invest in specific sectors, themes, or asset classes that you believe have the potential for higher returns. For example, you might allocate a portion of your portfolio to tech stocks, emerging markets, or green energy, areas that could outperform the broader market. To summarize, in a core satellite portfolio, about 70 to 80% is your core for stability and 20 to 30% is your satellite for growth. This keeps your portfolio balanced, steady at the center, with room for smart risk. The best part is flexibility. You can adjust the satellite based on the market or your goals. Say, when tech is booming, you can lean into it, and when things look shaky, you can get out. For core portfolio, these are some of the index funds, ETFs that you can invest across different regions like US, UK, Europe, and emerging markets. For satellite portfolio, these are some of the actively managed thematic funds that you can invest across different regions like US, UK, Europe, and emerging markets. Moving to the key takeaway sections. If you are a beginner, start investing in core portfolio to 100%. As Proverbs says, once you get the wisdom and understanding, slowly you can step up to invest in satellite portfolio based on your risk appetite. But remember, with great flexibility comes the need for discipline. It's important to rebalance your portfolio regularly to avoid overexposure. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. And if you have any questions or topics you'd like us to cover, drop them in the comments below. Thanks for watching, and happy investing.